Real options valuation. Real options valuation, also often termed real options analysis, ROF or ROA, applies option valuation techniques to capital budgeting decisions. A real option itself is the right, but not the obligation, to undertake certain business initiatives, such as deferring, abandoning, expanding, staging, or contracting a capital investment project. For example, the opportunity to invest in the expansion of a firm's factory, or alternatively to sell the factory, is a real call or put option, respectively. Real options are generally distinguished from conventional financial options in that they are not typically traded as securities, and do not usually involve decisions on an underlying asset that is traded as a financial security. A further distinction is that option holders here, i.e. management, can directly influence the value of the option's underlying project, whereas this is not a consideration as regards the underlying security of a financial option. Moreover, management cannot measure uncertainty in terms of volatility, and must instead rely on their perceptions of uncertainty. Unlike financial options, management also have to create or discover real options, and such creation and discovery process comprises an entrepreneurial or business task. Real options are most valuable when uncertainty is high. Management has significant flexibility to change the course of the project in a favorable direction and is willing to exercise the options. Real options analysis, as a discipline, extends from its application in corporate finance to decision-making under uncertainty in general, adapting the techniques developed for financial options to real-life decisions. For example, R&D managers can use real options valuation to help them deal with various uncertainties in making decisions about the allocation of resources among R&D projects. A non-business example might be the decision to join the workforce, or rather, to forego several years of income to attend graduate school. It, thus, forces decision-makers to be explicit about the assumptions underlying their projections, and for this reason ROF is increasingly employed as a tool in business strategy formulation. This extension of real options to real-world projects often requires customized decision support systems, because otherwise the complex compound real options will become too intractable to handle. Types of real options. The flexibility available to management, i.e. the actual real options, generically, will relate to project size, project timing, and the operation of the project once established. In all cases, any non-recoverable upfront expenditure related to this flexibility is the option premium. Real options are also commonly applied to stock valuation, see business valuation #option pricing approaches, as well as to various other applications referenced below. Options relating to project size. Where the project's scope is uncertain, flexibility as to the size of the relevant facilities is valuable, and constitutes optionality. Options relating to project life and timing. Where there is uncertainty as to when, and how, business or other conditions will eventuate, flexibility as to the timing of the relevant projects is valuable, and constitutes optionality. Growth options are perhaps the most generic in this category. These entail the option to exercise only those projects that appear to be profitable at the time of initiation. Options relating to project operation. Management may have flexibility relating to the product produced and / the process used in manufacture. This flexibility constitutes optionality. Valuation. Given the above, it is clear that there is an analogy between real options and financial options, and we would therefore expect options-based modeling and analysis to be applied here. At the same time, it is nevertheless important to understand why the more standard valuation techniques may not be applicable for ROF. Applicability of standard techniques. ROF is often contrasted with more standard techniques of capital budgeting, such as discounted cash flow, DCF, analysis, net present value, NPV. Under this standard NPV approach, future expected cash flows are present valued under the empirical probability measure at a discount rate that reflects the embedded risk in the project, CAP, APT, WACC. Here, Only the expected cash flows are considered, and the flexibility to alter corporate strategy in view of actual market realizations is ignored. See below, as well as corporate finance hash valuing flexibility. The NPV framework, implicitly, assumes that management is passive with regard to their capital investment once committed. Some analysts account for this uncertainty by adjusting the discount rate, for example by increasing the cost of capital, or 2. Adjusting the cash flows, for example using certainty equivalents, or 3. Applying subjective haircuts to the forecast numbers, or 4. Via probability weighting these, as in our NPV. Even when employed, however, these latter methods do not normally properly account for changes in risk over the project's life cycle and hence fail to appropriately adapt the risk adjustment. By contrast, ROF assumes that management is active and can continuously respond to market changes. Real options consider all scenarios, or states, and indicate the best corporate action in each of these contingent events. Because management adapts to each negative outcome by decreasing its exposure and to positive scenarios by scaling up, the firm benefits from uncertainty in the underlying market, achieving a lower variability of profits than under the commitment/NPV stance. The contingent nature of future profits in real option models is captured by employing the techniques developed for financial options in the literature on contingent claims analysis. Here the approach, known as risk-neutral valuation, consists in adjusting the probability distribution for risk consideration, while discounting at the risk-free rate. This technique is also known as the martingale approach, and uses a risk-neutral measure. For technical considerations here, see below. Given these different treatments, the real options value of a project is typically higher than the NPV, and the difference will be most marked in projects with major flexibility, contingency, and volatility. As for financial options, higher volatility of the underlying leads to higher value. An application of real options valuation in the Philippine banking industry exhibited that increased levels of income volatility may adversely affect option values on the loan portfolio, when the presence of information asymmetry is considered. In this case, increased volatility may limit the value of an option, part of the criticism, and subsequently slow adoption, of real options valuation in practice and academe stems from the generally higher values for underlying assets these functions generate. However, studies have shown that these models are reliable estimators of underlying asset value, when input values are properly identified. Options-based valuation. Although there is much similarity between the modeling of real options and financial options, ROF is distinguished from the latter, in that it takes into account uncertainty about the future evolution of the parameters that determine the value of the project, coupled with management's ability to respond to the evolution of these parameters. It is the combined effect of these that makes ROF technically more challenging than its alternatives. When valuing the real option, the analyst must therefore consider the inputs to the valuation method employed, and whether any technical limitations may apply. Conceptually, valuing a real option looks at the premium between inflows and outlays for a particular project. Inputs to the value of a real option, time, discount rates, volatility, cash inflows and outflows, are each affected by the terms of business, and external environmental factors that a project exists in. Terms of business as information regarding ownership, data collection costs, and patents, are formed in relation to political, environmental, socio-cultural, technological, environmental and legal factors that affect an industry. Just as terms of business are affected by external environmental factors, these same circumstances affect the volatility of returns, as well as the discount rate, as firm or project-specific risk. Furthermore, the external environmental influences that affect an industry affect projections on expected inflows and outlays. Valuation inputs. Given the similarity in valuation approach, the inputs required for modeling the real option correspond, generically, to those required for a financial option valuation. The specific application, though, is as follows. Valuation methods. The valuation methods usually employed, likewise, are adapted from techniques developed for valuing financial options. Note though that, in general, while most real problems allow for American-style exercise at any point, many points, in the project's life and are impacted by multiple underlying variables, the standard methods are limited either with regard to dimensionality, to early exercise, or to both. In selecting a model, therefore, analysts must make a trade-off between these considerations, see option, finance, #model implementation. The model must also be flexible enough to allow for the relevant decision rule to be coded appropriately at each decision point. Various other methods, aimed mainly at practitioners, have been developed for real option valuation. These typically use cash flow scenarios for the projection of the future payoff distribution, and are not based on restricting assumptions similar to those that underlie the closed form, or even numeric, solutions discussed. The most recent additions include the Data-Matthews method and the fuzzy payoff method. Limitations. The relevance of real options, even as a thought framework, may be limited due to market, organizational and/or technical considerations. When the framework is employed, therefore, the analyst must first ensure that ROF is relevant to the project in question. These considerations are as follows. Market characteristics. As discussed above, the market and environment underlying the project must be one where change is most evident, and the source, trends and evolution in product demand and supply, create the flexibility, contingency, and volatility which result in optionality. Without this, the NPV framework would be more relevant. Organizational considerations. Real options are particularly important for businesses with a few key characteristics, and may be less relevant otherwise. In overview, it is important to consider the following in determining that the RO framework is applicable. Technical considerations. Limitations as to the use of these models arise due to the contrast between real options and financial options, for which these were originally developed. The main difference is that the underlying is often not tradable. For example, the factory owner cannot easily sell the factory upon which he has the option. Additionally, the real option itself may also not be tradable. For example, the factory owner cannot sell the right to extend his factory to another party, only he can make this decision. Some real options, however, can be sold. For example, ownership of a vacant lot of land is a real option to develop that land in the future. Even where a market exists, for the underlying or for the option, in most cases there is limited, or no, market liquidity. Finally, even if the firm can actively adapt to market changes, it remains to determine the right paradigm to discount future claims. The difficulties are then. These issues are addressed via several interrelated assumptions. History. Whereas business managers have been making capital investment decisions for centuries, the term real option is relatively new, and was coined by Professor Stuart Myers of the MIT Sloan School of Management in 1977. In 1930, Irving Fisher wrote explicitly of the options available to a business owner, The Theory of Interest, 2:8. The description of such opportunities as real options, however, followed on the development of analytical techniques for financial options, such as Black-Scholes in 1973. As such, the term real option is closely tied to these option methods. Real options are today an active field of academic research. Professor Len Ostrageorgis has been a leading name for many years, publishing several influential books and academic articles. Other pioneering academics in the field include Professors Michael Brennan, Eduardo Schwartz, Graham Davis, Gonzalo Cortazar, Hans Smit, Avinash Dixit and Robert Pindick, the latter two, authoring the pioneering text in the discipline. An academic conference on real options is organized yearly, Annual International Conference on Real Options. Amongst others, the concept was popularized by Michael J. Mauboussin, then chief U.S. investment strategist for Credit Suisse First Boston. He uses real options to explain the gap between how the stock market prices some businesses and the intrinsic value for those businesses. Tregeorges also has broadened exposure to real options through layman articles in publications such as the Wall Street Journal. This popularization is such that ROF is now a standard offering in postgraduate finance degrees, and often, even in MBA curricula at many business schools. Recently, real options have been employed in business strategy, both for valuation purposes and as a conceptual framework. The idea of treating strategic investments as options was popularized by Timothy Lujan in two HBR articles. In financial terms, a business strategy is much more like a series of options than a series of static cash flows. Investment opportunities are plotted in an option space with dimensions volatility and value to cost, NPVQ. Lujan also co-authored with William Tiekner a Harvard Business School case study, Arundel Partners, The Sequel Project, in 1992, which may have been the first business school case study to teach ROF. Reflecting the mainstreaming of ROF, Professor Robert C. Merton discussed the essential points of Arundel in his Nobel Prize lecture in 1997. Arundel involves a group of investors that is considering acquiring the sequel rights to a portfolio of yet-to-be-released feature films. In particular, the investors must determine the value of the sequel rights before any of the first films are produced. Here, the investors face two main choices. They can produce an original movie and sequel at the same time, or they can wait to decide on a sequel after the original film is released. The second approach, he states, provides the option not to make a sequel in the event the original movie is not successful. This real option has economic worth and can be valued monetarily using an option pricing model. See option, filmmaking.